My greetings to everyone. In the ongoing lectures of entrepreneurship and new venture planning, today we are discussing about the arrangement of the funds, which is supposed to be a very important aspect for the entrepreneur. So we have discussed few sources in the first part. Let us continue with the other sources of finance. We have already discussed about the debentures, but just a small recap. Debenture is a formal instrument used by the companies to acknowledge a loan taken from the investor. It represents a promise to pay after a fixed period of time with a fixed interest rate. They are secured as well as unsecured, and it helps in increasing the earnings of the shareholder and also helps in retaining the ownership by the owner. There is a flexibility in the capital structure. It is cost effective funding and assures the risk for the investor, and there is a low risk, and many debentures are secured against the specific assets, reducing the default risk for the investor. Then of course, it is a long term source of fund. The debentures provide a long term capital ideal for funding the infrastructure expansion projects and the purchase of the fixed assets. There are certain limitations of the debentures, like you have to have a fixed financial obligations which they have to pay. The company must pay the interest regularly and redeem the principal amount on the maturity regardless of the profit levels. So this creates a financial pressure, especially during the downturns for the company, and it is unsuitable for the companies with the irregular income because they cannot sustain a regular pressure of the debenture holder. Then there is an increased risk for the shareholders. A high level of debenture raises the financial risk borne by the equity shareholders, and in times of the distress, the shareholders may lose the value and their expected return increases, raising the company's overall cost of capital. There is also a pressure of maturity payment pressure, that is on the date they have to pay. There is a reduced borrowing capacity. Heavy use of debentures can affect a company's credit worthiness, and the banks and the financial institutions may hesitate to lend to a company already burdened with the debt. There is a restriction on the use of the secured assets. If the debentures are secured against the assets, those assets cannot be used again for other loans, limiting the company's borrowing flexibility. So, debentures offers a very strategic way to raise the long-term funds without diluting the ownership. They are cost effective and offer the stable returns for the investors. However, the companies must carefully assess their ability to meet the fixed obligation and manage the repayment risk. Debentures are best suited for the business with the consistent cash flows and a strong asset base. Now we are coming on to the public deposits as another source of fund. Public deposits refers to the fund raised directly by the companies from the general public. These are unsecured borrowings, typically for a short term, and are offered with the interest rates that are higher than those provided by the banks to the depositors, but the lower than the companies pay on the bank loans. So this method is a very popular method in the sectors like manufacturing and the real estate, and also for the transportation, where the companies often require quick, flexible, short-term financing. The deposits are usually invited through the advertisements in the newspapers or the company's website and are governed under the Companies Acceptance and Deposit Rules 2014, issued by the Companies Act 2013. There are certain merits of the public deposits. The first and the foremost is a simple process. The raising of the funds through the public deposits does not require any complex procedure. A company simply needs to issue an advertisement in the newspaper declaring its intent and details of the scheme. And also it is very cost effective. Public deposits carry a lower interest rate than the commercial. So, a company like Fab Industries, they may offer 8% interest on the public deposits, while the banks would change to 11% for a similar business loan. So, this 3% saving helps to improve the profitability of the company. Then we are talking about the short term funding, the explanation part of it. The public deposits are very ideal for meeting the short term needs like working capital, raw material, purchase of the operational cost, and typically issued for a period ranging from 6 months to 3 years. Then, a transport company facing a seasonal surge in the orders may raise 5 crore via 1-year public deposits to purchase the additional vehicle or the fuel. Then there is no asset restriction. Since these are unsecured loans, the companies do not need to pledge any asset, unlike the bank loans or the secured debentures. Like for example, the Delta Chemicals raises 10 crores through public deposits to upgrade its machinery while keeping its fixed assets basically for the future bank loans or the leases. There is no voting rights for the public deposits. The public deposit holders are the creditors, not the shareholders, so they have no say in the company's management decisions or voting rights at the meetings. For example, even if 1,000 individuals invest in the Sunrise Limited through the public deposits, they cannot influence the board decisions or vote in the shareholder meeting. Now coming on to the explanation part of it, since the interest or the public deposits is fixed, any excess profits can be distributed to the shareholders as the higher dividends without increasing the company's borrowing cost. For example, Omega Textiles Limited has an excellent year and makes the substantial profit. It still pays only the agreed 8% interest to the depositors and distributes a higher dividend to its shareholders. Now coming on to the limitations. The unsecured nature. The public deposits are not backed by any collateral, which make investors hesitant, especially in the times of uncertainty. During a market downturn, the ordinary investors may avoid depositing in ABC Limited, fearing that in case of the default, they will not have any asset claim or the security. Only the reputed and the financial stable companies can attract the public deposits. Startups or the lesser known firms may fail to generate the sufficient trust. For example, Tata Motors or L&T can easily raise 100 crores through the public deposits, while a new company like Urban Tools Private Limited may struggle to raise even a 1 crore due to a lack of credibility. Then we have a risk of early withdrawals. The public deposit schemes often allow early withdrawals under the certain conditions, and during the financial crisis or panic, mass withdrawals can cause a serious liquidity issues. For example, if a rumor spreads about the financial troubles in the Globe Transport Limited, a large number of depositors may demand a premature redemption, creating a cash flow crisis for the company. Then we have a misuse of funds. There are no stringent restrictions on how the company uses the public deposit money. This may lead to misallocation, fraud, or speculative investments by unethical management. For example, ABC Real Estate Limited raises a 250 crore through the public deposits and the land acquisitions, but diverts a 15 crore for unrelated high-risk trading activities, resulting in investor losses. For example, public deposit serves as a flexible, quick and cost-effective method of raising the short-term finance. So, they can be a significant risk for the depositors due to their unsecured nature and the companies due to the potential liquidity issues and a regular scrutiny. So, the proper governance, transparency and the reputation may key for successful managing this source of finance. Then coming on to another source called lease finance. Lease financing is a contractual arrangement in which one party, that is the lessor, allows another party, that is the lessee, to use an asset for a specified period in exchange for the periodic payments known as a lease rental. The ownership of the asset remains with the lessor during the lease period. The lessee gets a right to use the asset without having to purchase it outrightly, making a leasing a strategic tool for managing the capital expenditure and accessing the modern technology or the infrastructure. Then we have commonly leased assets include machinery and manufacturing equipment, commercial vehicles and fleets, computers and IT facilities, and office furniture and the photocopiers. At the end of the lease term, Depending on the lease agreement, the lessee may return the asset to the lessor, renew the lease, purchase an asset at a market value, or pre-agreed prices. So, the price financing, lease financing is often used as an off-balance sheet financing, meaning the leased asset and the liability do not appear on the lessee's balance sheet under certain lease structures. This helps maintain the financial ratios and borrowing capital and the borrowing capacity. There are two different types of leases. Operating lease, that is the features they have is a short term lease, often less than the asset's useful life. Asset ownership and maintain remain with the lessor, and a lease end, the asset is returned or the lease to another party. For example, ABC Advertising Agency, it leases a high-end printer for a supplier for 2 years, and the supplier maintains the printer and replaces them at the end of the term. Then we have a finance lease, that is the capital lease. The features are as follows. It is having a long-term lease, usually for most of all the assets' useful life, and the lease bears a maintenance and the servicing responsibility, and the lease payments covers the cost of the asset plus a profit margin of the lessor. XYZ Logistic Limited, for example, requires the delivery truck. A leasing firm purchases the truck and leases them for 5 years, during which XYZ is responsible for its repair, insurance and servicing. There are certain merits of this, like immediate payment. It receives the full payment for the equipment from the leasing company, reducing the credit risk. For example, the Bosch Tools India sells a 1 crore machinery unit to a leasing company, which then leases it to a customer. The Bosch receives the full payment up front. So, and there is no the collection hassles. So, the suppliers do not deal with an EMI or a rent collection. Once sold to the lessor, all financial responsibilities immediately shift, and for the lessor, that is the leasing company, for the lessee, that is the business or the individual using the asset. So, the profit from the lease rental, it earns a steady stream of income through the lease payments. For example, SBI Leasing Services, it lesses out a 50 commercial vehicle to a transport firm for 1 lakh, that is the month each, generating a 50 lakh month in the revenue. There is an asset ownership also. It retains the ownership and can repossess or lease the asset again after the lease expiry. After 4-year lease, for example, the term ends. The leased computers can be reimbursed and refurbished and leased to the educational institutions at a very lower cost. Then we have a cost effective alternative to the loans. The fixed monthly lease payments are often lower than the bank loans, that is the EMIs. For example, the Green Farm Foods leases the cold storage equipment at 70,000 per month instead of taking a bank loan that would cost them 1 lakh per month in EMI with a high upfront margin requirements. There is a protection against the inflation also. The lease payments are fixed in advance, unaffected by the future cost increases. For example, a transport company leases the bus in 2023 at about 85,000 per month per unit, and if the prices rises to 2025, their lease cost remains unchanged. There is also a low initial capital requirement, no need to purchase the asset upfront, and it saves the working capital for other operations. For example, a startup IT company leases and serves and laptops instead of investing 20 lakhs upfront, preserving a cash for the talent acquisition and the marketing. Then we have a technological upgrade, easy to switch to newer models at the end of the lease term. For example, Pixel Studios, it leases Apple computers for a graphic design, and after 3 years, they upgrade to the latest MacBook and the Pro models through a new lease. Then we have an access to the modern assets. The business can stay competitive by accessing the latest technology without the ownership burdens. Then we have the tax advantages. The lease rentals are treated as the business expenses and are fully tax deductibles. There are certain limitations of the lease finance like mandatory payment obligations. The lessee must pay the lease installment even during the financial stress or the underperformance. There is a depreciation risk. In the finance leases, the lessor bears the risk of asset value depreciation, and there is a maintenance and the servicing cost also. The lessee, especially under the finance lease, is responsible for upkeep, the repairs and also the insurance. So, at the end we can say, as far as the lease finance is concerned, the lease finance offers a very practical and the financially efficient solution for the business to access the assets without tying up the capital. It supports the operational flexibility, technological advancement and the tax efficiency. However, the lessee must carefully analyze the terms, responsibilities and the financial obligations before entering into a lease. So, particularly under the finance lease, whereas maintenance and the risk responsibilities are very significant. The next is your bill of exchange. A bill of exchange is a legally binding written and the signed financial instrument in which one party, that is the drawer, directs another party, that is the drawee, to pay a specified sum of money to a third party or to a drawer himself, either on demand or at a future fixed date. It is commonly used in the trade transactions, especially where the goods and the services are sold on the credit. It serves as both a credit instrument and a credit assurance of the payment. So, to formalize the transaction, B, that is the seller, a drawer of the bill of exchange on A, stating that A will pay rupees 1 lakh to B for a third party on a specified date after the 5 months. A accepts the bill by signing it, indicating an agreement to pay on the due date. So, there are certain key parties involved. The first is the drawer. The person who creates the bill, usually the seller or the creditor. The second is your drawee, that is the person who accepts and agrees to the pay, that is usually a buyer or a debtor. Next we have a payee, the person to whom the amount is to be paid. It can be a drawer or it can be some another party also. There are certain merits of bill of exchange, like the first is it facilitates the credit purchases. A bill of exchange enables the smooth credit transaction by allowing the buyer to purchase the goods and the services now and pay later on a mutually agreed date. For example, a garment retailer buys the cloth in bulk from the manufacturer on a 3-month credit. The manufacturer draws a bill of exchange for the due amount and the retailer accepts it. So, the formal arrangement ensures its retailer gets the good immediately while the manufacturer gets a guarantee payment later. It also acts as a legal document. So, it is a negotiable instrument when you talk about, because it acts like a bill or it acts like a legal document, that is the bill of exchange. It is under the Negotiable Instrument Act 1881 and has the legal enforceability. In case of a default, the seller can sue the buyer in the court using the bill as an evidence. For example, if the buyer refuses to pay on the due date, the seller can present the bill in the court as a valid legal claim and seek the compensation, making it more secure than a verbal promise or an informal agreement. It is also having an option for the early payment, and of course, it also aids for the financial planning and the cash flow arrangements. So, it also serves as a formal reminder for a timely payment, because the bill itself acts as a written, dated reminder of the payment obligation. It also puts a pressure on the drawee to pay on time to avoid any dishonor and any mispayment. For example, a retailer with an accepted bill maturing at 1st December is constantly aware of the upcoming liability and ensures the sufficient balance in their account by that date to avoid the penalties or the legal complications. So, at the end, as far as the bill of exchange is concerned, we can say that a bill of exchange plays a very crucial role in the trade finance by combining the credit extension, legal assurance and the financial flexibility. It is especially important in B2B transaction where goods and services are supplied on credit, its negotiable nature, easy of transfer, the legal strength make it a preferred instrument in domestic and international commerce. Next is your bank financing. Bank financing is also a financial instrument to support extended by the commercial banks to the individuals, entrepreneurs and the companies. It is used by the various purposes including the business startups, expansion assets, purchase, working capital needs and the operational continuity. It is considered as a secure, regulated and a flexible form external funding. It can take any forms and shape, like first we have a bank loan. Bank loan is a lump sum amount provided by the bank for a fixed term at an agreed interest rates. It is generally repaid in monthly or a quarterly installment and may be secured, which is collateral based or unsecured. So, the features are as follows. It has disbursed as one time payment, the repayment schedule and the interest rates are very fixed. It has a credit evaluation which is done before approval and it is used for the capital expenditure, expansion and the business setup. So, there are different types of the bank loans, which we have a term loan for a fixed period, we have demand loan which is payable on demand by the bank, often used for the short term needs, and also the cash credit, that is the revolving credit. The cash credit is a flexible borrowing arrangement where the limit is sanctioned based on the working capital needs, typically secured against the inventory or accounts receivables. The borrowers can withdraw the money as needed and repay it any time within the limit. Interest is charged only on the amount withdrawn, not the total limit. The security, that is the inventory, receivables or other assets. It is renewable yearly upon review and useful for working capital needs. For example, ABC Textiles Limited is sanctioned a cash credit limit of 20 lakhs at 11% interest. So, in June, the company withdraws rupees 8 lakhs, interest in calculated only for 8 lakhs, not for the 20 lakhs. And if the company deposits 4 lakh in August, interest therefore is charged only on the remaining 4 lakhs. There is an overdraft facility also. An overdraft allows a current account holder to withdraw the money then is available in their account up to the sanction limit. It is a short term finance option often used for urgent needs or the temporary liquidity gaps. For example, it is allowed for the current account holders and the interest is charged only for the overdrawn amount. For the number of days used, it can be secured as well as unsecured. And of course, then we have a bill discounting, which is a short term financing method where the business sets all their bill of exchanges or the trade receivables to a bank date before the maturity date to get the immediate funds need. So, this is how it is a very reliable system, structured way for the business individuals to meet the various financing needs. Each form of financing, whether the term loans for the capital expenditure, cash credit for the working capital or bill discounting for the liquidity, it also caters to the specific requirements, and understanding the features, cost and obligations of each helps the business optimize their financial planning and also the cash management. Then we have a venture capital, which is provided for the high growth potential but the limited access to the traditional funding sources like loans. In exchange, the venture capitalists receive an equity stake in the company and also participate actively in the strategic and the management decisions. It supports the innovation, encourages the entrepreneurship and generates the employment, stimulates the economic growth and builds the new individual and transforms them into the existing markets. And there is a how the venture capital work. It is a source of fund the venture capitalist pools the money from the institution investors like the pension funds, endowment funds, high net worth individuals to form a venture capital fund. Then of course, these funds are deployed in the early stage ventures with a high scalability and the profit potentials in exchange for equity, board representation and control over the decisions. It is also the support provided for the capital investment, strategic guidance, mentorship, operational support and access to the business network and the co-investors. It also helps in the risk and returns, and the high risk ventures are balanced by potentially enormous returns, and one successful investment, WhatsApp, Flipkart, can offset the multiple failed ones. Then it has some risk mitigation strategies, that is portfolio diversification, co-investments and active monitoring for this. And of course, as far as the due diligence is concerned, a detailed evaluation of the product, finance, market, team, industry is done, and if the due diligence is successful, a short sheet is drafted outlining the investment amount, ownership percentage, the board representation, the exit conditions, etc. So, after negotiations and signing, the funds are distributed. So, this is also supposed to be a very important fund which helps in the large funding, and no immediate repayment is there. Strategic guidance and mentorship it provides, and it also access to the networks, but on the darker side it has certain challenges, that is the loss of control, pressure to grow rapidly and dilution of the ownership is there as far as the venture capital is concerned. So, venture capital is a very powerful enabler to the entrepreneurship and innovation, especially for the startups and the disruptive ideas, but the limited resources. It offers not just funding but also the strategic partnerships and mentoring. However, it comes with the expectations of the fast growth, loss of autonomy and a demanding investment life cycle. So, overall this is also very important, and also nowadays many other types of fundings are also available, like we have the angel investors. They just do not offer money, but they can come up to years of business experience and are willing to provide strategic guidance also. And also as far as the dynamic environment is concerned, every now and then we understand the nature is changing, the types of funds are changing, so on and so forth. Thank you very much.